Hi, my name is Brad Cable, and I am president and a private wealth manager with Bradley Cable Incorporated. I am also a financial advisor with LPL Financial, the largest independent broker-dealer in the country based on revenue. With these presentations, I hope to provide valuable information to people that seek strategies to navigating what has become a very complex financial environment. I encourage you to email or call if you have any questions on the topics presented. A quick contact form can be found in the Contact Us section of our website. Thank you for taking the time. Welcome, and thank you for joining me to discuss an important and timely topic today, Roth IRA conversions. After a lifetime of saving and investing, the goal in retirement is to preserve wealth and invest it in a way to generate lasting retirement income or provide an income legacy for your heirs. We will discuss a strategy that can help you meet your income and legacy objectives by seeking to minimize taxes. What's more, because of certain income restrictions, this strategy may be available to you for the first time beginning in 2010. People retiring today face challenges unlike many of their predecessors, including the fact that people live longer puts more pressure on their savings to last more years in retirement. Changes to employer retirement plans have resulted in less sources of guaranteed income such as pensions. The responsibility for saving for retirement has generally shifted from corporations to individuals. The task of making contributions, selecting investments, and preparing for income rests with you and your advisor. Retirees have typically relied on three different sources to meet income needs in retirement: Social Security, retirement plans such as pensions, 401ks, and IRAs, and personal savings. This is sometimes referred to as the three-legged stool of retirement. Each source is being challenged in some form or another. Because of various factors including federal budget deficits and demographic trends, our Social Security system must be reformed in order to ensure its future health. These changes may include increased payroll taxes, decreased or delayed benefits, or a combination of all. In fact, without any changes, tax revenues will fall below program costs beginning in 2016, and the projected point at which the trust funds will be exhausted is 2037. Social Security Administration, May of 2009. Until the beginning of 2009, the personal savings rate in the U.S. decreased dramatically over the past 20 years. In 1987, the savings rate was 7%. In 2007, it was less than 1%, according to the U.S. Department of Commerce, Bureau of Economic Statistics. Lastly, the good news is that 70% of U.S. households currently own a retirement plan through work or an IRA. However, these retirement plans today are predominantly defined contribution plans, not traditional defined benefit pension plans. Defined contribution plans put more of the responsibility on individual account owners to make the right decisions on their future. Making the right decisions for a secure retirement involves many factors such as selecting the appropriate investments, deciding the right time to retire, and setting a course for taking income in retirement. Another major element is how to account for taxes that can jeopardize your financial success in retirement. To examine this topic further, let's consider how these sources are taxed in retirement. Social Security. Depending on your income level, as much as 85% of Social Security benefits may have to be reported as income on your tax return. Currently, you will generally have to pay federal taxes on your benefits if you file a federal tax return as an individual and your total income is more than $25,000. If you file a joint return, you will generally have to pay taxes if you and your spouse have a total income that is more than $32,000. Personal savings. Earnings may be taxed as income or capital gains depending on the investment vehicle. Retirement plans, IRAs, are generally, except Roth accounts, taxed at ordinary income rates when withdrawn. Additionally, penalties may apply on early withdrawals. In fact, at current federal income tax rates, $1 inside a retirement plan or IRA may only provide 65 cents of income once taxes are accounted for, assuming highest current income tax bracket of 35%. Since many retirees hold a large portion of their savings inside these traditional retirement accounts and IRAs, taxes can have a major impact on their ability to generate their desired amount of income. So how concerned should we be about taxes in the future? During the past 50 years, tax rates have been at current levels or lower only 10% of the time. If tax rates revert back to pre-1980s levels, the tax savings investors enjoyed during their working years could be more than offset by higher taxes in retirement. Considering the current economic and political landscape, the prospect of rising tax rates must be allowed for as part of a comprehensive retirement strategy. So how can we prepare for the negative impact of taxes in retirement, especially with respect to our retirement plans and IRAs? The Roth IRA was established by legislation passed into law in 1997. Although investors cannot deduct contributions like traditional IRAs, withdrawals are not taxed when distributions occur, assuming certain requirements are met. Roth IRA accounts can be funded from contributions or conversions from existing traditional IRAs or retirement plans. For the purposes of our discussion, we will focus on conversions. The Tax Increase Prevention and Reconciliation Act of 2005, TIPRA, changes the rules governing conversions of traditional IRAs into Roth IRAs. Starting in 2010, Roth IRA conversions will be available to all taxpayers regardless of income. Through 2009, taxpayers with more than $100,000 in modified adjusted gross income are eligible for conversion. Note that modified adjusted gross income excludes the amount included in gross income resulting from the conversion and certain other items of income. Conversions from a traditional IRA to a Roth IRA are treated as taxable distributions. However, under the new law, taxpayers who convert in 2010 can elect to pay the federal income tax due in 2 equal installments by reporting 50% of the income on their 2011 federal tax return, which is generally due April 15, 2012, and the remaining 50% on their 2012 federal income tax return, generally due April 15, 2013. Note that some taxpayers will find it beneficial to report the entire amount of the income from a conversion on their 2010 tax return based on individual circumstances or if they believe overall tax rates will be higher after 2010. Note on Roth IRA distributions. In order to be considered qualified for tax purposes, Roth IRA distributions must meet certain tests. First, the Roth account must be established for at least 5 years. Second, the distribution must meet one of these requirements: age 59 and a half, death, disability, or as a qualified first-time homebuyer. Since contributions to Roth IRAs are made after tax, account owners can always remove contributions without taxes or penalty. Additional rules apply to conversions. Investors should consult with their financial advisor and a qualified tax professional. The fact that Roth IRAs offer tax-free withdrawals is appealing to retirees looking to generate income in retirement. Let's explore some specific instances where a Roth IRA conversion strategy can yield benefits. Large percentage of investment assets in traditional retirement accounts. Certain statistics, EBRI, Individual Retirement Account Plans, May 2006, indicate that among families with retirement accounts, these resources accounted for over 60% of their total financial assets. This concentration of assets has occurred as personal income tax rates decline to low levels. Converting some traditional assets to Roth can help act as a hedge against the direction of future tax rates. This is a similar concept as not putting all of your eggs in one basket when it comes to diversifying your investment assets across various asset classes. Retirees should also consider diversifying for taxes. That is, hold some assets within taxable accounts, some within tax-deferred accounts such as traditional IRAs, and some assets within tax-free accounts such as Roth IRAs. Don't rely on retirement accounts for income. Some affluent retirees do not rely on their retirement accounts to meet their income needs. In these cases, being forced to take required minimum distributions at age 70 and a half may be a nuisance, since the income must be reported on the tax return. As retirees get older, these RMDs will greatly increase each year because of their short life expectancy. Conversely, the fact that there are no RMDs with Roth IRAs means that more assets can remain in the account for future tax-free growth. Continued in Part 2.